If you're planning to upgrade your equipment, buy a work vehicle, or invest back into your business this year, you could be sitting on one of the biggest legal tax write offs available. In 2025, Section 179 and bonus depreciation have both been supercharged. Today, I'll break down exactly how they work, what changed this year, and how to choose the right one for your situation. So you keep more cash in your business instead of sending it to the IRS. Let's start from the basics. Depreciation simply means recovering the cost of stuff your business uses for more than 1 year. The IRS calls these kinds of assets business property. In everyday accounting, we often say fixed assets. They both mean the same thing, things your business keeps and uses over time. The IRS doesn't let you deduct it all at once unless you use a special rule. Under the modified accelerated cost recovery system, most fixed assets are written off over 5 to 15 years, but Section 179 and bonus depreciation let you speed that up dramatically. So, when we say fixed asset, we're really talking about the same thing the IRS calls business property. These are the bigger, long term items your company buys to use, not to sell. Things like your laptop, your delivery van, your office furniture, or your equipment. If it lasts more than a year and helps you earn money, it's likely a fixed asset. That's different from short term supplies or tools you use up quickly. Those are regular expenses. And remember, to claim depreciation, you need to use the asset mainly for business, typically more than 50% of the time. Without any special election, those assets get deducted slowly. A $50,000 equipment might give you $10,000 per year over 5 years. Section 179 and bonus depreciation exist to let you accelerate that, which can make a huge cash flow difference when you're growing. Let's take that $50,000 equipment example and see how Section 179 changes the story. Under Section 179, you can deduct the entire $50,000 in the same year you bought it, as long as it's used more than 50% for business. So instead of spreading out your write off for years, you get the full deduction right now. For a small business owner in a 30% tax bracket, that could mean saving around $15,000 in taxes this year alone. In 2025, the maximum you can deduct under Section 179 is $2.5 million. And if your total spending on equipment goes beyond $4 million, that limit starts phasing out dollar for dollar. That's why this rule is such a huge deal for small and mid-sized businesses. It's designed to help you reinvest faster and keep cash in your operation instead of waiting years to recover it. Here's one key rule. Section 179 stops at your taxable business income. If your company only made $120,000, you can't deduct more than $120,000 under 179 this year. The rest carries to future years. Bonus depreciation doesn't have that restriction. Now, let's talk about Section 179's phase out. Say your company buys $5 million of gear this year. That's $1 million over the limit, so your 179 deduction drops from 2.5 to 1.5 million. At $6.5 million in purchases, the 179 benefit disappears completely. Okay, now how does the bonus depreciation work then? It's basically the fast-track cousin of 179. For 2025, it's back to 100% depreciation for qualifying assets bought and placed in service after January 19th. Anything earlier in January falls into a 40% window. That difference in timing can literally change your write-off amount by tens of thousands. The last time this was at full 100% was 2022. Then it was reduced to 80% in 2023, 60% in 2024, and was supposed to be 40% in 2025 under the original TCJA before the One Big Beautiful Bill Act was signed in July this year. And again, as briefly mentioned earlier, bonus depreciation doesn't have an income limit and can deduct everything at once. This is why it can be so powerful to use Section 179 and bonus depreciation together to write everything off without limitation. Let me show you a quick summary on key differences between Section 179 and bonus depreciation and tell you why I said to use them together. Even though these two deductions feel similar, they each have strengths that work best in different situations. Section 179 is usually your first tool because it gives you a lot of control. You can choose which assets to write off, how much to deduct, and you can tailor the deduction to match your income for the year. It is great for small and mid-sized businesses that want intentional, strategic deductions, especially in states that follow the federal Section 179 rules. Bonus depreciation works differently. There is no dollar limit, and it is not restricted by your business income. That means bonus depreciation can create a loss, which Section 179 cannot do. It is a powerful way to wipe out remaining basis on assets once you have used Section 179, or when you are making very large purchases that exceed the $2.5 million cap. The trade off is that many states like California, New York, and New Jersey do not conform to federal bonus rules. So you may get the deduction federally, but not on your state return. So here's the smart sequence. You generally take Section 179 first to maximize both your federal and state benefits. After that, whatever basis is left can be deducted using bonus depreciation. When you layer them in that order, you get the flexibility of Section 179 and the extra horsepower of bonus depreciation, often resulting in a full write-off in the first year. Understanding how they complement each other is what makes this strategy so effective for year-end tax planning. Now that you understand how Section 179 and bonus depreciation work together, let's look at one of the most common assets where people use these deductions: business vehicles. Vehicles follow all the normal depreciation rules, but they also have a completely separate set of limits that depend on one single factor, which is the vehicle's weight rating. Inside the driver's side door frame, there is a label that shows the GVWR, which stands for Gross Vehicle Weight Rating. This number determines how much you can deduct in the first year. If the vehicle weighs less than 6,000 pounds, it falls under what the IRS calls the luxury auto limits. That name is misleading because it applies to regular cars too. For 2025, the maximum first-year deduction for a passenger vehicle is roughly $20,200 when bonus depreciation is used, and about $12,200 without bonus. Even if the car costs $50,000 or $80,000, you cannot write off the full amount in 1 year. If the vehicle weighs between 6,000 and 14,000 pounds, it is treated as a heavy SUV for tax purposes. Heavy SUVs can take Section 179, but there is a cap. In 2025, the maximum 179 deduction for a heavy SUV is $31,300. After you apply that amount, any remaining basis can usually be deducted with bonus depreciation. Finally, some vehicles can qualify for the full 179 deduction without any cap at all. This applies to certain work vehicles such as pickup trucks with a bed longer than 6 feet, cargo vans without rear seating, and vehicles designed to carry more than 9 passengers. These are considered non-personal use vehicles, and they are treated differently because their primary design is for business, not for commuting or personal travel. Understanding these 3 categories is the key to knowing how much you can deduct. The vehicle's weight drives the deduction, not the sticker price. In the next slide, I will show you a clear example using 2 different vehicles so you can see how much of a difference this weight rule makes in real life. Both vehicles in this example have a purchase price of $50,000, but they fall into 2 different IRS categories. First, imagine you buy a $50,000 SUV that weighs a little over 6,000 pounds. Because it is treated as a heavy SUV, you can take Section 179 up to the $31,300 cap, and then you can usually apply bonus depreciation to deduct the remaining cost. In many cases, this lets you write off the entire $50,000 in the first year. Now compare that to a $50,000 passenger car that weighs less than 6,000 pounds. Even though the cost is the same, the IRS luxury auto limits apply. That means in year 1, you can only deduct up to about $20,200 with bonus depreciation, or around $12,200 without bonus. The rest of the cost has to be depreciated over several years, so you end up with 2 vehicles that cost exactly the same, but the deductions in year 1 are completely different. The SUV may get a full write-off, while the car is capped far below the purchase price. This is why checking the weight rating before you buy a business vehicle is one of the smartest tax planning steps you can take. Beyond vehicles and equipment, certain building upgrades can qualify too, like a new roof, HVAC, or security system. And yes, software counts if it's an off the shelf product like QuickBooks or Adobe Creative Cloud, not custom software you code in house. Before we wrap up, there's one more concept you need to know: depreciation recapture. Anytime you deduct the full cost of an asset up front, like with Section 179 or bonus depreciation, and then sell that asset later for more than its written down value, the IRS wants to reclaim part of that earlier tax benefit. That amount is called depreciation recapture, and it's taxed as ordinary income. Let's use the same example we've been working with. Imagine you wrote off a $50,000 work vehicle in 2025 using Section 179. 2 years later, you sell the truck for $25,000. Since your adjusted basis is zero, the entire $25,000 is considered recapture. It isn't a capital gain. It's treated just like regular business income. Recapture isn't a penalty. It simply levels things out when you got a big deduction up front. The good news is that if you sell an asset for less than its remaining basis, there's no recapture at all. When you do sell, you'll report the details on Form 4797. Just keep this rule in mind when planning major purchases or deciding how long you expect to keep an asset. Okay, my final tip. Every deduction should be backed by paperwork. Keep receipts, payment confirmations, and photos of the asset in use. And don't forget to report it properly on Form 4562. That's where Section 179 and bonus depreciation live on your tax return. Thank you for watching.